Welcome to this week's Simple Economic Update. My name is Jason Hamilton, and in this video, we're going to discuss oil prices and the significant impact that they have on the global economy, influencing everything from gasoline cost to the price of goods and services to the direction of financial markets. The relationship between oil and the economy is bidirectional. Stable oil prices can stimulate economic growth, while a growing economy increases oil demand. Recent geopolitical tensions, particularly the Middle East conflict, have caused oil prices to rise, potentially affecting portfolios and the broader economy in the coming months. So over the next few minutes, we'll provide perspective on this topic and why investors should continue to focus on longer run trends despite all the daily headlines. All right, first, this chart shows oil prices over time. Brent crude, which is the global benchmark of oil prices, rose 13% to $78 per barrel recently due to the Middle East conflicts, but it still remains relatively flat year to date and well below the 2022 peak levels. Despite geopolitical tensions, oil prices have not yet surpassed $100 per barrel, as some might fear would happen. Oil price movements are always uncertain, and predicting oil prices is very difficult. Historically, oil price trends are influenced by both geopolitical events affecting supply and economic growth impacting demand. The biggest spike in oil prices of recent years occurred when Russia invaded Ukraine in 2022. This led to a jump in gasoline prices and spurred inflation around the world. Fortunately, oil prices are much lower today. Short-term disruptions to supply are possible, which is keeping markets on edge. Next, this chart shows that U.S. oil production rose dramatically due to the shale revolution and new technologies. U.S. production has finally rebounded to new all-time highs following years of depressed activity as a result of the pandemic. U.S. oil production now exceeds 13.2 million barrels per day and allows the U.S. to potentially act as a swing producer to increase supply during high oil prices, helping to insulate the country from geopolitical shocks. That said, the U.S. still depends on foreign imports due to the need for different types of oil. The longer-run picture for oil is quite different from the current short-term concerns. The International Energy Agency projects world oil production to outpace demand in the coming years, partly due to U.S. production and changing OPEC's dynamics. However, despite factors like growing renewable energy adoption, the world remains heavily reliant on oil, which means it remains a transmission mechanism for geopolitical tension to the economy. Finally, this chart tracks gasoline prices over the past quarter century, with the dotted line representing the average price over the period. It shows that while oil prices have risen, gasoline prices have fallen and remain well below the $5 per gallon peak seen in 2022, unless you're in California, of course. Higher gas prices effectively act as a tax on households, reducing disposable income and potentially impacting retail sales and corporate earnings. For investors, having exposure to the energy sector is an important way to offset oil price swings. For instance, the energy sector outperformed in 2021 and 2022 amid market stress, serving as a reminder of the importance of maintaining a diversified portfolio. But rather than react to daily geopolitical headlines, it's better to remain focused on your long-term goals. As usual, we've only scratched the surface on this topic, but we hope you found these insights helpful. If you have any questions, please don't hesitate to reach out. You can find us at keepitsimplefinancial.com, and we hope you have a great week.